Silver just experienced one of the most dramatic crashes in precious metals history, plummeting nearly 50% from its all-time high in just weeks. And the trigger wasn't some economic catastrophe or geopolitical crisis. It was a simple change in margin requirements by the Chicago Mercantile Exchange that sent leveraged traders scrambling for the exits and turned what looked like an unstoppable rally into a bloodbath. Monday, February 16, New York time. Comment your date below so I can see where you're watching from. If you value this work, subscribe and comment George Williams. It really helps. Today, silver is trading at $78.90 per ounce, up $3.74, which is a gain of nearly 5%. While that might sound encouraging, we need to understand what just happened over the past few weeks, because this recovery is happening against the backdrop of one of the most violent sell-offs the silver market has ever seen. On January 29th, silver touched its all-time high, a level that had traders and investors celebrating what seemed like the beginning of a new era for the white metal. But that celebration was short-lived. Within weeks, silver had lost nearly half its value, erasing gains that took months to build, and leaving many traders wondering what went wrong. The catalyst for this crash wasn't weak fundamentals or collapsing demand. In fact, the fundamental story for silver has never been stronger, which makes this sell-off even more significant to understand. The real trigger was a decision by the CME group, the exchange where silver futures are traded, to increase margin requirements from 11% to 15% right as the market was hitting those record highs. Now, if you're not familiar with how margin works in futures trading, let me break this down in simple terms, because understanding this mechanism is crucial to understanding why silver crashed so violently and what it means for where prices might go next. When you trade futures contracts, you don't need to put up the full value of the contract. Instead, you post what's called margin, which is essentially a good faith deposit that ensures you can cover potential losses. Before the CME's decision, traders only needed to post 11% of the contract value to control a position. That means with $10,000, a trader could control a position worth over $90,000. This is what we call leverage, and it's a double-edged sword. When prices move in your favor, your gains are amplified dramatically. A 10% move in silver prices could potentially double your account if you're leveraged 9-to-1. But when prices move against you, losses accumulate just as fast, and that's where the danger comes in. The CME raised margin requirements to 15% specifically because silver had become too volatile and speculative activity had reached extreme levels. By increasing the margin requirement, the exchange was essentially telling traders they needed to put up more cash to hold the same positions. For someone who had maximized their leverage at 11% margins, this change meant they suddenly needed to come up with significantly more capital or close out positions. Many highly leveraged speculators simply didn't have the extra cash sitting around, so they had no choice but to sell. And when everyone tries to sell at the same time in a leveraged market, you don't get an orderly decline. You get a cascade of forced liquidations where selling begets more selling, stops get triggered, and prices gap violently lower. This is exactly what happened to silver. The margin hike forced the most leveraged players out of the market, and their selling triggered stop losses from other traders, which created more selling pressure, which triggered more stops, and the whole thing spiraled into a brutal deleveraging event. It's worth noting that this wasn't the first time we've seen margin hikes kill a precious metals rally. The same playbook was used in 2011 when silver was making a run toward $50. The exchanges raised margins multiple times, and each hike coincided with sharp sell-offs that eventually ended the rally. Whether you view these margin hikes as necessary risk management by the exchanges or as deliberate attempts to kill speculative rallies depends on your perspective, but the market impact is undeniable. Now here's where things get really interesting. U.S. Treasury Secretary Scott Bessent publicly attributed these extreme swings to Chinese traders, describing the recent rally as a speculative blow-off. This is significant because it suggests that regulators and policymakers were watching the silver market closely and were concerned about the level of speculation. When government officials start talking about speculative excess in a market, it often precedes regulatory action, and in this case, the CME's margin hike might have been influenced by these concerns. The characterization of Chinese traders as the primary speculators is notable because it points to international capital flows chasing momentum in the silver market, which can amplify both rallies and crashes. Despite this violent correction, silver is still up 162.45% compared to a year ago. Let that sink in for a moment. Even after losing half its value from the peak, silver has more than doubled over the past 12 months. The 52-week range tells the story of this volatility perfectly. The low was $29.11, and the high was $121.78. That's a range of over $90 in a single year, which is absolutely extraordinary for a commodity market. Today's trading range of $74.65 to $78.42 shows we're still seeing significant intraday volatility, though nothing like the wild swings we saw during the peak of the sell-off. So where does silver go from here? To answer that question, we need to look at both the fundamental drivers and the technical picture, because right now they're telling somewhat different stories. On the fundamental side, the case for higher silver prices remains incredibly strong. The silver market is expected to remain in deficit for a sixth consecutive year in 2026, with supply falling short of demand by 67 million ounces. Think about what that means. For 6 years running, the world has been consuming more silver than it produces, and that deficit is being filled by drawing down above-ground inventories. This isn't a sustainable situation, and at some point, those inventory drawdowns will be exhausted, which could lead to significant price spikes when physical shortages become apparent. The industrial demand story for silver is particularly compelling. Solar panel manufacturers are now consuming over 25% of annual global silver supply, and that consumption hit new all-time highs in both 2024 and 2025. As the world continues to transition toward renewable energy, this demand is only going to increase. Solar installations are accelerating globally, driven by both climate policies and the improving economics of solar power, and every panel requires silver for its photovoltaic cells. Similarly, electric vehicle-related silver demand jumped an estimated 20% in 2025, driven by growing use of sensors and high-voltage wiring in EVs. As vehicle electrification continues, this represents another structural demand driver that should support prices over the medium to long term. On the investment side, global exchange-traded product holdings stand at an estimated 1.31 billion ounces, with coin and bar demand strengthening in recent months. This suggests that despite the price volatility, investors are still accumulating physical silver, which provides a floor under the market. The combination of strong industrial demand, investment demand, and structural supply deficits creates a fundamental backdrop that should be supportive of higher prices over time. Add to this the expectation that the Federal Reserve will ease monetary policy by roughly 60 basis points by year-end, and you have a macro environment that typically favors precious metals. Weaker U.S. economic data has already shifted expectations toward easier monetary policy, with December retail sales unexpectedly stalling, which pressured the dollar and created tailwinds for dollar-denominated commodities like silver. Some analysts are forecasting that silver could reach $100 to $175 or higher in 2026, which from current levels of $78.90 would represent substantial upside. These predictions are based on the combination of supply deficits, industrial demand growth, and potential monetary easing, creating a perfect storm for silver. However, we need to balance this bullish fundamental case against the very real technical and sentiment challenges the market faces right now. From a technical perspective, silver is in a precarious position. The recent crash has badly damaged the chart structure, and many technical indicators are flashing sell signals. The daily technical indicators show a strong sell based on both traditional indicators and moving averages, which suggests that momentum traders and algorithms are still positioned bearishly. Silver needs to reclaim key levels and rebuild a constructive chart pattern before technical traders will feel comfortable buying aggressively again. The fact that we've seen a 5% bounce today is encouraging and suggests that bargain hunters are stepping in at these levels, but one day doesn't make a trend, and we need to see sustained buying pressure and higher lows to confirm that a bottom is in place. The upcoming US CPI report is a critical near-term catalyst that could determine silver's direction in the coming weeks. Markets are expecting both headline and core inflation to show 2.5% year-over-year gains in January. If inflation comes in softer than expected, it would reinforce expectations for Fed easing, which should weaken the dollar and provide support for silver and other precious metals. Conversely, if inflation runs hotter than expected, it could push back expectations for rate cuts, strengthen the dollar, and create headwinds for silver. This makes the CPI release a potential inflection point that traders need to watch closely. Looking at potential price targets, if silver can hold above the $74 to $75 area and start building a base, the next resistance levels to watch would be around $85 to $90, which represents roughly a 50% retracement of the decline from the all-time high. A move back above $90 would be technically significant and could attract momentum buyers back into the market. On the downside, if 74 fails to hold, we could see a retest of the $60 to $65 area, which would represent a deeper retracement and potentially shake out more weak hands before a sustainable bottom forms. The key question for traders is whether this crash represents a healthy correction in an ongoing bull market or the end of the rally altogether. The answer likely depends on how silver behaves over the next few weeks and months. If we see steady accumulation at these levels, with higher lows and consolidation, rather than another leg down, it would suggest that smart money is viewing this as a buying opportunity and that the fundamental drivers will eventually reassert themselves. If instead we see continued selling pressure and new lows, it might indicate that the speculative excess needs more time to be worked off, and that the market needs to go through a longer healing process. One thing traders need to be aware of is the possibility of additional margin hikes if silver starts rallying aggressively again. The CME has shown they're willing to step in when they perceive excessive speculation, and if we see another parabolic move, there's nothing stopping them from raising margins again. This creates a potential ceiling on how fast silver can rally without triggering regulatory intervention, which is an important risk factor to consider. The exchanges have effectively put a governor on the market's ability to move vertically, which means any future rallies are likely to be more gradual and less speculative in nature. For traders and investors trying to navigate this market, the lesson from this crash is clear. Leverage is dangerous, especially in volatile markets, and position sizing matters enormously. Many traders who were right about silver's long-term direction still got wiped out because they were over-leveraged and couldn't withstand the volatility. If you're going to trade silver, you need to use appropriate position sizes, have stop losses in place, and understand that these markets can move against you faster and further than you expect. The traders who survived this crash intact are the ones who weren't using maximum leverage and who had the financial cushion to weather the storm. For longer-term investors who believe in the fundamental story, this type of volatility actually creates opportunity. The structural supply deficit, industrial demand growth, and monetary policy backdrop haven't changed. What's changed is sentiment and positioning, which is exactly when patient capital can accumulate positions at better prices. The challenge is having the discipline to buy when everyone else is scared and the conviction to hold through volatility. As we look ahead, silver's path will likely be determined by the interplay between these strong fundamentals and the damaged technical picture. The fundamentals argue for significantly higher prices over time, while the technicals suggest caution in the near term. The smart approach is probably to watch for signs that a bottom is forming, look for constructive price action like higher lows and improving momentum, and be ready to add exposure if silver can reclaim key technical levels while the fundamental story continues to strengthen. The upcoming CPI data, any changes in Fed policy expectations, and developments in the physical market around supply and demand will all be important signposts to watch. This market has shown it can move violently in both directions, which creates both risk and opportunity depending on how you approach it.